This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. So let's say you're in the airport. You're walking through. You want to buy the new book. And you look up, and there's a blue book with yellow lettering, and it says, An Economist Walks into a Brothel and Other Unexpected Places to Understand Risk. Now, you got to give that author credit. That title stops you. An Economist Walks into a Brothel. And the economist that happens to walk into the brothel is female, not male. My guest today is Allison Schrager. And she really is the economist that walked into the brothel. Like literally, serious, true, as she will explain. I love the word risk. She clearly loves it too. Because, whether we think about it or not, every day we take these big risks. We take these small risks. But we can't opt out of the risk. The risk doesn't go away. We can't just say, oh no, we're not going to be involved in society. We're not going to be involved in risk. Allison has gone down the path to pull together what she sees 5 of the most important principles for dealing with risk. Principles used by some of the most important thinkers today in their risk analysis. Because let's face it, it's all about mitigating that downside risk. How can we put a floor under trouble? Without any further delay, let's jump right into my guest today, Allison Schrager, and let's talk to the economist that walked into the brothel. Allison, I'm looking at this fine blue book in front of me, An Economist Walks into a Brothel. I posted a picture of this today to my Facebook, and one friend of mine immediately said, wow, that's the kind of book that really turns your head when you're in the airport. Me being the smart ass, I said, why is that? And he being the smart ass back, wrote back and said, well, any book that has the word economist on the cover, I pay attention. That is a great title. That is the title that makes you pause at the airport.
Yeah, thank you. I'm not very good at titles normally. I actually did come up with that one. I'm normally a terrible title person. I'm notorious for that as a journalist. Actually, it was a subhead of a chapter. It was the publisher's idea to use it as the title of the book, but I'm still taking credit for it.
Sometimes publishers are funny. Sometimes I find, having done 5 books, I find some of their title stuff is useful or not useful, but occasionally they do have something as an outsider that helps us. And so there you go in your situation, huh?
Yeah. I think you also find when you write a book that it's ultimately not your decision.
Yes.
It's a good thing they picked a good one.
Yeah, that's one of the dirty little secrets that people that are non-authors don't understand, how much control on some things that we don't have. Unless we fight a lot, then we can maybe get a little bit more to our side. But
you can strenuously object and say it makes you sad, and they'll weigh that. But that's really all you can do.
Hey, listen, this word risk, this 4-letter risk, and I must say, there was one thing, what I hear, you've got one part, which I love. There's a lot of things in here I love. But I must say, I thought I had it registered, but I don't. No risk, no reward. I actually own norisknoreturn.com. I've had that for a long time. So I thought I had the no risk, no reward, but somebody else has had it for a long time. But risk is the great word. And I know you have been inspired, and I'm sure you view your work as an inspiration, not directly to this one book that I'm thinking of. You've got many influences, but Peter Bernstein's Against the Gods must have affected you.
Oh, I love that book so much. I was just at a celebration of Bob Merton's work, who was really my intellectual influence. While I was there, I met the editor of that book. Just thing to meeting Peter Bernstein, who unfortunately is dead, but this is as good as it gets now. I was just raving to him about, it means so much to me that if you look at my Amazon page now, it's like Against the Gods and Capital Ideas are also most viewed with my book, which would have just been my dream writing it, because I love that book so much. The one issue I have with it is I feel like it's a little long and a little dense, and I wanted to do something that would take these really important ideas and make them accessible to a broader audience.
You've definitely done that, but I don't want to, it's not as thick as Against the Gods, but you've definitely got some weight in here in terms of intellectual weight. It's not flimsy by any stretch of the imagination.
Thank you. Yeah, they're heavy issues. Sometimes people will say, well, there wasn't anything new in it. I'm like, it was based on a 7-year postdoctoral training with a Nobel Prize winner, but thank you.
That's what happens. You get reduced to a tweet. Hey, let's get back to your cover title, because this is kind of fun and interesting and everyone wants to know about it. I can't say that I have any personal experience with, well, I can't really say a lot here. Most men can't. It's just one of these interesting titles. You cause people to have all kinds of reactions. I have spent a lot of time in Vegas, though, but I never made it outside of Vegas to the desert, to the double wides, to where the brothels are in the middle of nowhere in Nevada. But you have.
Oh, yeah. Yeah. I've spent, if you sum it up, a couple of weeks there. Yeah, which is a lot. Yeah, I don't think most men would go. It's a very particular kind of person who goes to a brothel. I don't mean that with any judgment, good or bad. It's a unique experience for sure.
Now, you spent weeks there. Was this all, of course it was all research. I mean,
yeah. Oh, yeah.
Speak to me though, the weeks, this was just talking with everybody. I mean, observing, you had access.
Well, if I sum up, it's weeks. I went the first time, it was early days when I was thinking about the book, actually to do my connection to the brothel. They don't just let everyone in, especially they wouldn't just let most researchers just come to ask all the women how much money they're making. That took a relationship that took some time to build. Initially, how this all happened is the brothel contacted me because they wanted me to write about them. Initially, I was like, I don't really think so. But then they started explaining to me that the way it works is they don't have set prices. So every transaction's individually negotiated. And I was like, well, that's quite interesting. So you're telling who are 18 years old, negotiating with men who are millionaires over tens of thousands in their 60s. And I'm like, well, yeah, it's interesting. No one's ever asked about that. So we have a negotiation training programs to help them know how to do this. And I'm like, well, that's very interesting. They had me come out. I was there on and off for 2 weeks going through their negotiation training program. They also have a very good financial literacy program. I had a relationship with them for that. One of the things I was really surprised by when I was there was how much they could charge, not only because of their negotiation skills, but just that the market would bear such a. And it dawned on me it was a risk price because prices are driven by risk. So when I was writing the book, I asked if I could come back and collect more data on prices, and that's how that happened.
Two things that struck me, I guess, to kind of sum it, because people are going to have to go check the book out. Essentially, the workers there, the ladies there, they're taking a 50% cut. So they're giving away 50% to reduce their risk on an assortment of issues. The customers are paying a 300% markup. Very interesting data right there from the very 30,000 foot view down.
In a traditional criminal market, you have this flawed risk distribution. Because if a market works well, the person who takes the most risk should get the biggest reward in a transaction or the biggest expected reward. In crime, often because you don't have this transparency, you end up with this flawed distribution where people, you hear this about low-level drug dealers, take the biggest risk, often don't get the biggest reward either. And that's how I normally think of sex work, is pimps push these poor women or sometimes men out into the field, they take the biggest risk, and then they take all their money. I thought the brothel was quite interesting in that Dennis Hoff, who owned the brothel, and I guess brothel is a company, they take their money as that spread. The customers pay a markup, the providers have to take this huge pay cut, and the spread between that is what the brothel takes, and that is providing a safe encounter for both buyers and sellers. So it's a really interesting flip on sort of how I think about the original pimp market relationship.
Dennis Hoff, for those that watch all kinds of stuff, will recognize the name. He has been out and about, no longer with us. I believe he passed. A very widely known name, quite the character, to say the least.
Yeah, I think it was also my feelings about Dennis Hoff that kept attracting me to this story. He is such an interesting man. It was such an interesting thing to watch. I think certainly it feels like in these times, we get these very one-dimensional stories with very sort of clear heroes, villains, victims. Dennis was a complicated guy, and what goes on in a brothel is a very complicated thing. You want to judge it or not judge it. You have this man who's making all of his money by having women have sex with other men. That's very icky, I guess, especially in a post-Me Too world. But on the other hand, he's teaching these women great business skills. And for a lot of them, he's the first person who's told them that, hey, you need to set life goals beyond here. And here's how you can work to get them. Here are some life skills you can have that will go beyond this brothel that are really valuable. Taking people, a lot of them who never even had bank accounts, and giving them financial literacy trainings. I had a lot of complicated feelings about that, which I just kept wanting to explore.
Vegas, I should say, not too far away, pretty interesting because I guess there's a minor scale of what's going on out in the desert, unregulated inside Vegas. I knew an associate years ago. She had her MBA. She worked at one of the adult establishments in Vegas, shaking her moneymaker, so to speak, and she was making $20,000 a month in her early 40s. It's an interesting world. People, they figure out where's the reward and what's the risk. Where's the reward and what's the risk? Essentially what your book forces us to think about at every moment.
It's in every market. That was my original idea, was just we think about finance and how we measure risk in financial markets, but they're in every market. We're paying to reduce or paying less to take on risk all the time.
What's your definition of risk? I always like to think, well, if I'm losing money, what can I lose? That seems like the best way for me to think about risk. What's your view of risk?
That's at risk. I think I have a more technical definition, which is, for me, risk is the range of things that could happen, good or bad. It's all the things you can imagine happening and measure happening. Risk is about the future. When we make a decision about the future, you don't know what's going to happen. So risk for me it would be like a probability distribution if you were to think about it mathematically. It's all the things that could happen, good or bad, and how likely they are.
Is there any synonym in your mind for risk? Because I think when most people hear it, if they're not accustomed to your world, they hear risk and it sounds technical to them, or it sounds frightening, or perhaps for some people, they think, I'm just going to avoid that. I'm not going to take any risk. Well, that doesn't exactly work, does it?
No, I think that the more simple message of the book is you should definitely take more risk, because that's how you get what you want. I mean, no risk, no reward, or no risk, no return. This is how you get ahead. You have to take risks in relationships, in your career. I mean, you can avoid risk, but you won't probably have as rich a life. But I think it doesn't end there. I think you hear a lot of you need to take more risks to get more out of life. I think that's true, but that doesn't mean you have to take stupid risks. When you take a risk, you can't manage your risk. That certainly increases the odds things go well, or at the very least, you can reduce the odds things go badly. It's never completely risk-free. You're not going to get what you want out of life, or you're not going to live sort of the life you fully are capable of unless you do take risks regularly. We have a negative association with the word risk because there's reasons we focus on the downside, and those are very good reasons for doing that. But we also need to consider the upside too.
I just finished watching a documentary about Bill Murray, the actor-comedian. The documentary, the setup is that for years, decades, Bill Murray inserts himself into random people's lives. He shows up at their house. He's in their pictures. He's at the bar, tending bar. He shows up and cleans the dishes at college kids' houses. The most fascinating documentary, it really paints the picture of what you're talking about, is that in his way, as this superstar, world-famous person, he's finding that those everyday risks for him are satisfying. And I think beyond the math of the risk that you talk about quite clearly in your work, it's just those everyday risks that so many of us stop taking. We just say, well, we're not going to do that. We're not going to do that. And we forget that when you're a kid and you take a risk, that's when you get the reward. Those are the memories. And if you stop doing that, what's left?
Totally. And what's interesting about that is I have a very mathematical way of understanding risk, because I studied it, in that context. But often the biggest risks we take are interpersonal risks. Like when he's doing that, he's taking a huge risk. Is this going to be awkward? Is this going to be weird? Are these people going to be psychos? Often the most rewarding risks we take are emotional. That was why I was surprised about the brothel, is the most high-end service that costs the most. And I think why the reason people visit brothels to begin with is intimacy and connection is one of the most rewarding things we can experience, but it's also a very high risk thing because rejection feels awful. I discovered this is really what attracts people to brothels, is people who are somehow connection impaired, but want to feel that in a low risk environment. When you visit a sex worker, she gives you something called the girlfriend experience, which is effectively intimacy for sale. It's limited, obviously, or sort of an illusion because it's not real, because no one's giving you intimacy by choice. Well, it's by choice, but not of their own, just because they like you. There's also nothing at risk because you sort of know the terms and there's no real scope for rejection.
My associate that I told you about that was making the money, she told me how that typically went down in the club. She made the most. Everyone was kind of jealous of her because since she had her MBA, she could talk. She was very bright. She would end up having celebrity clients that would come in. They didn't want to see her shake. They wanted to sit and talk with her for 5 and 6 hours. That's all they wanted. She had found out a way to really reduce her risk.
Yeah, and in the brothel too, women in their 40s tended to be the biggest earners.
Before we move off the brothel, just as curiosity, because I'm sure everyone wants to know, the girlfriend experience at the desert brothel somewhere in Nevada, the price of the girlfriend experience is what? Or is, as you said, negotiable? I mean, it could go up to who knows what?
Yeah, I mean, it tends to have a big markup on it. I think I found like it typically would be about like $1,200 an hour.
It's easier to find a lady in your life, I think. I don't know.
Well, I said, like, there's downside risk. A lot of people really are paralyzed by a fear of rejection. I met a lot of people there. You go in there and you expect to be finding all the customers just gross and easy, but really they just seem lonely, sort of afraid of really connecting with people in another way. This is what they do.
There was a great Bourdain episode a couple years ago when he was in Japan going through nighttime Tokyo, and essentially the same thing. People wanted to avoid rejection, so they would pay for the fantasy.
Yeah, and we have a way of sort of paint this picture of sex worker customers as these horrible people, but I feel bad for them mostly.
The thing that you've done to move away from brothels and strip clubs for a second, the thing that you've done that's interesting is you're finding these unusual markets to study, which really gives us great contrast and great insights. How did you first start to understand that the unusual markets could be interesting?
Well, I've always found them interesting.
There had to have been a start somewhere.
Well, I think it's like 'cause I've had a strange background. I'm a retirement economist. That's my training. PhD in economics, where I focused on the economics of retirement. And then I spent years working with finance with financial economists on the retirement problems. Quirky markets isn't maybe something you'd associate with me. I also worked as a journalist on and off. I always found I was most drawn to these sort of quirky stories. The economist in me loves to take apart markets and understand how they work, what's driving them, and how prices are formed. I like quirky markets because often you can see these subtleties you don't see in normal markets because they just so operate in a new way. So I find as an economist, my knowledge is deepened. And I also just like talking to people. When I was thinking about doing a book, I was like, why don't I just make it on quirky markets? I love doing it. It's really fun for me. I find I learn the most, which means the reader can learn the most too.
Years back, I was involved in a documentary. I had the good fortune to interview some of the most prominent poker players of the day. Some of them today are still most prominent. In fact, one of the ones, this guy, Anthony Estafardi, I believe his name is. My gosh, he's gone on to just make an absolute bloody fortune. You started to get into poker, though, to bring your analysis into poker. And you were looking at the high stakes, and you were looking at the situation where people start to really get a run, perhaps, so they've got a lot at stake. And then their emotions, their psychology, their personal psychology can deviate. And you kind of got to know that it can deviate. And you've also got to be aware of the pot, because at some stage of the game, depending on how big the pot gets, the utility of the money really starts to play a role.
Yeah. So it's sort of the classic example of loss aversion, which is when you're down, you tend to play more aggressively. When you're losing money, people take more risks. When they have money, they tend to be risk averse. Classical economics would assume that you should be consistent in both places. And you should be, because statistically, the hand you get dealt in poker has nothing to do with whether or not you've been losing or winning that evening. I talked to Phil Hellmuth, who's this notorious poker player, not only for being one of the best poker players in the world, but also for throwing these tantrums whenever he loses. And what I found interesting about him is he's so emotional and sort of volatile, yet when he plays, he's so disciplined. He only plays like 12% of his hands. It's consistent whether or not he's up or down. And that is so different than what we think of this behavioral bias, as psychologists call them, that you can't be consistent. And you wouldn't expect someone who's so emotional to also be so disciplined when he plays. Turns out it took him years of training and really sort of focus to learn how to be in the moment and not let his emotions affect his bidding.
Clarify that for me for a second. The emotional part, I wasn't following that. He gets emotional after he loses, or obviously not during his play. So when he loses is when he blows off steam, so to speak.
Yeah, he throws these tantrums, he yells at people. He might even be playing against some amateur. He'll like tell them they're terrible and don't deserve to be there. He's this very emotional guy. And even when I spoke to him—
That's after he's out, though.
Yes, he holds it together and then he just goes nuts.
Interesting.
In the beginning, he wasn't so disciplined. It took him a while to sort of learn how to hold it in when it mattered.
Did you ask him why he still has the need when he loses to blow it off like that? What has he not figured out by now that must be doing something for him? That must be an asset for him.
I think it's part of his brand, for sure. I think he's trademarked Poker Brat. It's his brand. Also, I think it's actually genuinely sincere. Because even when I interviewed him, he says he has ADHD. I think he kind of has a swagger to him. I think part of it is really genuine. I think he's just sort of a very emotional guy.
You said ADHD. It makes me also think perhaps some of the guys that we see that get to the higher level math or perhaps even poker. I had a chance to interview Vernon Smith, who got the Nobel Prize years back. Asperger's. Is there an advantage there for some folks that can really bring their understanding of risk down in that way where they can? Generally, I still remember asking Dr. Smith, we were setting up in his office to interview him, and I said, hey, are we going to bother you setting all these lights up and stuff? And he's like, he looked at me and he goes, I won't know you're here. So fabulous. It was like, okay, that threw me.
I never thought about it, but perhaps. I think certainly in finance, people, I think of these Asperger's guys as being these like trading savants, because trading is a lot like poker, being cold and rational, not thinking about, am I winning, am I losing, and having that not affect your trading strategy is probably valuable. Perhaps this ability to just see the numbers and not get caught up in the motion of it is an asset. I don't know. I'm not sure if there's any studies on it. I'm sure there is, but I'm unaware of them.
I like the phrase, though, in your work, I am irrational and I know it. That's so good, right?
Yeah. Well, I think it's because as an economist, I find it unsatisfying when psychologists document all these biases and sort of just shrug. The economist to me is a problem solver. It's like, if there's a market failure, what can we do? And I'm like, if there's a behavioral bias, well, can we get better? There's a lot of evidence people have. Like I said, if you look at Phil, he has trained himself to overcome his behavioral biases, at least when it matters or when it comes to his livelihood. And there's also evidence that traders, he said, tend to be more rational, or anyone who has a lot of experience taking risks and bets tends not to fall into these traps. I really got into the work of Gerd Gigerenzer when I was writing the book, because he keeps using this expression risk literacy, which is we train people to how to think about risk, train people to understand what a probability is. People tend to not show these same biases as much. It's not that we just have to shrug our head and be like, well, I'm irrational and I guess I just have to deal with it. If we actually know it and come to terms with it, we can make better decisions.
Did you ever see Gerd in his band?
No. He has a band?
There's like a commercial that you can find online, because I've interviewed him, and there's a commercial you can find online. I want to say it was for Volkswagen or whatnot. He was in a band. Maybe I'm going completely crazy, but before he became this prominent guy in the field. Yeah, I'll find the link and send it to you. It's fabulous.
Really? What was he like to interview? I was just fascinated by him.
I've talked to him a couple times at least. He's great. He's fabulous. I mean, the accent's fabulous. His last book, Risk Savvy, was quite nice. The one thing I really liked that he did that really struck me, and I try to tell this to people when people say, you should go to the doctor, you should get a checkup, you should go do this, let the doctors run a test on you, da, 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 da. And then he points out, he's like, hey, hold on. Every male is going to get prostate something bad as they age. Now, the trick is, if you're not symptomatic and you run off and you get one of these invasive tests, next thing you know, you're going to have a hard time with the toilet for the rest of your life. He brings that counterintuitive, as you know, he brings that counterintuitive spirit to thinking, which you've done as well.
Yeah, and I don't know, I just find everything he says just so sensible. I like that he has solutions. I feel like he's been very critical of economics, but I feel like in some ways it reminds me more of economics, which is, hey, here's something, how can we make this better?
Well, it's like kind of the simple heuristic mindset. If you are looking, for example, at a price, any market price, if it's going up, well, okay, it's going up. We've got some momentum on our side. If it's going down, well, it's going down. The momentum's going down. Whereas somebody else could say, I must tell you why that price is going up. Gerd would just say, simple heuristic, it's going up.
Well, isn't that what an economist would say too? I mean, that's a very efficient markets kind of attitude, which is prices reflect the information. It is what it is.
Except there are some healthy debates about the efficient market hypothesis, which we won't go into today. I would probably go towards I wish Benoit Mandelbrot was still alive. I'd get him involved in the conversation too, right?
Yeah, I guess, all those years I spent at DFA with Gene Fama, I tend to be an efficient markets person. It's it. Maybe he's more like economists, or at least certain economists, and he realizes.
Well, and then his most successful student at AQR will come out and say, Cliff Hassness will come out and say, well, market's efficient? No way. He doesn't say it exactly that way. He hedges his bets.
Yeah. He hedges. He's like, markets are mostly efficient, but I can make money. So.
Hey, let me take you to another one, which I thought was interesting. I never thought of. Paparazzi. How did that come onto your plate as one to study?
Someone mentioned to me that they knew someone was paparazzo and that he had a really interesting risk strategy, but he wouldn't talk to me. This was actually the community that I found the hardest to infiltrate. I live in a neighborhood in New York that is near a lot of very trendy celebrities. So once I heard this, I got very intrigued of, well, what is going on? What does happen? What risk management are they? I never really thought much about it before. I was like, yeah, these people face a lot of risk. They face a lot of, certainly idiosyncratic risk. And any given day, they might see someone and make, get 100,000, or most days they're going to make no money, or maybe only $5 or $10. That's a lot of risk. I guess they do have to have different techniques to manage that risk too.
When you say it's a lot of risk, I mean, as an outsider, I'm imagining maybe they don't have a nice Upper East Side apartment and they live somewhere else 30, 40 miles outside the city, and they just got to kind of hang out and keep their expenses low. So map out for us newbies about the risks of being a paparazzo.
It's very similar to financial markets or a stock price, which we normally think of as roughly having two: idiosyncratic and systematic risk. And the idiosyncratic risk is the risk that individual stock will rise or fall based on things unique to that stock. Every individual paparazzo also faces a lot of idiosyncratic risk. And that, as I said, they'll tell me stories of, I spent like 5 hours waiting for Alec Baldwin and I never saw him, but then I was walking home and I saw Kristen Stewart making out with her new girlfriend. I mean, that is just such random luck. They manage that risk. So I said, their incomes are incredibly volatile. That makes it hard in life. They manage that risk the same way you would in the stock market, which is through diversification. If you own a lot of stocks, you don't notice idiosyncratic risk. What they do is they form alliances of other paparazzo and they share tips or sometimes royalties depending on the arrangement. But the problem is you always have an incentive to cheat on your alliance, because if you have an exclusive shot, you get more. So their alliances always are falling apart. So they all hate each other, which is one of the reasons it's hard to be a paparazzo. Is there's a lot of good friendships, but there's also like a lot of bitterness between them too, because they've all cheated on each other past. It's actually much harder than it used to be. Like when you were saying how they don't live on the Upper East Side, like they probably did or could have maybe 10, 15 years ago. Since a lot of the celebrity picture industries moved online and the agents who are sort of the intermediaries who sell their pictures have consolidated, this is sort of a systematic risk, which is, the risk the whole market will fall, which is before in like peak paparazzi years, which would have been the Britney Spears umbrella shaved head day. This is called the gold rush era. They could make maybe $15,000 for a picture of a celebrity getting coffee. Now that picture would only bring in $5. The market has just completely changed, and there's just a lot less money for a paparazzo now. So it's a much harder life than it used to be, and that kind of risk is much harder to deal with.
I'm not trying to take you down a specific table of contents path in your book. So if I feel like I'm jumping around, well, I am, because I just want to pick your mind. You've got all kinds of interesting stuff going on. People need to go read the book. They can't just depend on me to read them the table of contents. That's not what I'm here for. I'm here to ask you an interesting question, perhaps to see if there's something that we can still be gleaned about. Let's see, what the summer of 1998, August of 1998, all kinds of interesting stuff happened there. I think some people that were really involved in the August of 1998, specifically long-term capital management. Boy, there was fantastic lessons on risk to be taken away from that experience.
Yeah, people involved, you would think they would understand risk better than anyone.
What was one of the classic lines? I can't remember which individual in the firm was the quote, but it was something about the picking up the nickels or the dimes in front of the steamroller just looks so good. And then the tidy ball of string or whatever, just these things that it could never happen. They had it all figured out. It can never happen. And I guess someone like Mr. Taleb in The Black Swan has laid out a case for many years now as to why it could happen.
Yeah, I think that was in the chapter I had about surfing, that you have all these ways you can make big wave surfing safer. But you know what? You're on a 80-foot wave, you're on an 80-foot wave. It's never risk-free. And if you take a lot of leverage, you're exposed to a lot of risk. And it can work out for a while, but eventually it just won't.
I'm curious, do you think behind the scenes after that event, there were probably a few others, that was the big one, do you think some of these blow-ups, and of course we would see ripples in the markets if it happened, but I tend to think that some of that bad press that really happened around some of the bigger blowouts in the last, like I said, it hasn't been any for a little while, but I just wonder if some of the blowouts have gone underground, so to speak, if people try to not be as prominent. Or have we just been in a non-risk-taking market since, March of 2009, and everything's just gone straight up, and there's no more risk ever again in the stock market?
Those are fatal words. I think markets have gone up. And what happens is you get a strategy and it works, then markets change and then it doesn't work. I think whatever happens that causes a recession or whatever market event happens, the tide goes out and you see who's naked. I think it's dangerous to ever think the risk went away. I think most people in finance definitely don't want the sort of scrutiny that comes with that. I think LTCM, no one would have ever heard of it. There's some dramatic story Bob's told me about how when they needed to be bought or needed a big capital injection, Warren Buffett was very close to doing it, but there was I can't remember, some drama, some missed phone call where it didn't happen. So they ended up needing the private sector to give them this capital injection. If that hadn't happened, just given them the money they needed or bought the firm, we would have never heard of them. This probably does happen more than we realize. It's just when there seems to be some sort of government involvement that all of a sudden it feels like, hey, what's going on here?
Yeah, I would think today maybe that if a big player is taking too much risk and perhaps goes over the side of the boat, other big players, it's in their own best interest to perhaps make sure that it doesn't happen in a public way. But that's just me theorizing.
Yeah, I guess we have no way of knowing.
Let me take you to another fun one, which I think we can all kind of relate to. We follow this from afar. We'll hear about, for example, I remember the classic movie. I mentioned Bill Murray, Lost in Translation, made by Sofia Coppola. I think it cost her like $4 million. Of course, Dad was quite famous and his production company made it, and Bill Murray was quite famous. But that film, almost 20 years ago, made like $125 million, I believe. So $4 or $5 million investment, $125 million. I mean, that's a major home run, right? But Hollywood is notorious for getting this all wrong. And the funny thing is, after going through your work, I think the conclusion you leave me with is that they've still not even come close to figuring it out in Hollywood, have they?
Some risk problems are just a lot harder than others because in finance, you measure risk using data from the past. If markets change and you have to have this sort of skill and foresight to know when the data has changed, it doesn't become as useful. Hollywood's particularly, a movie industry in general, is a particularly hard risk to measure because the market changes so much. Think about streaming. Like that didn't exist several years ago. So does data about whether or not a movie is going to be profitable 10 years ago tell you anything now? I think like 10 years ago, people still had DVD sales. That market's dead. Now just the whole economics of the industry changes. That makes it a particularly hard risk to measure, but that doesn't stop. What I found, I think this unknown, because it's probably not so interesting to everyone's story in Hollywood, is that it seems like every 5 years or so, someone comes into Hollywood and says, but I can solve this problem. I have this algorithm that can predict which movies are going to be winners and losers. Certainly, I think we're going to be seeing this a lot more in industries and a lot of risks that are immeasurable now that we have both throw around things like big data, algorithm, machine learning, that all of a sudden I can measure these risks we always thought were immeasurable. And it's true to some extent. More data is better and you get more precision and all this stuff. But you know what? You can have the fanciest technology in the world and the best computers in the world and tons of data in the world. But if a market has totally changed, it really doesn't tell you much.
It brings to mind for me the fashion. I'm going to go back to Hollywood in a second, but I just want to interject the fashion company Zara. They've made their fortune so far on being able to adjust to those changing tastes. And I think that's somewhat where Hollywood has not yet figured out how to adjust quickly to changing tastes.
One of the reasons Zara has is it sort of makes these cheap clothes really fast. It takes a long time to make a movie. From conception to production, the market can change in the middle of that. I guess the question is, how do you stay nimble?
I want to add something to Hollywood, and I'm not sure if you're familiar with him or not, but Jason Blum, he was the guy behind Paranormal Activity. He's actually, and look, Hollywood has always been kind of a venture capital model to some degree, but Blum has done it really interesting where he goes to, let's say, like, let's make the film for $1 million. Let's really put some cost constraints on it and get everybody to buy into the backside, if there's a backside. And that model's been really successful for him. He's made a bloody fortune doing it that way.
Yeah, although I think what people don't realize is horror films, I spent a lot of time plotting risk distributions, probability distributions of profitability with different types of films. And people think horror films are such a sure bet because they're relatively cheap to make and they pay off big. Of all the different types of films, horror films and thrillers actually tend to be the least profitable. They have a very long, thin tail. It is like VC there.
So there's a few big winners and we hear about those, but we don't hear about all the other wasted money.
Yeah, it's like tech. It's like a successful horror film is like a unicorn. It's very hard to make money off of horror films, much harder than I would have expected. Instead of all the distributions I looked at, I think horror film had the most in the loss category and probably the longest tail.
Yeah, I could keep you there for a while, but I wanted to shift you into retirement a little bit. Getting to retirement today, and I jotted this down from your work, reject safety, go for more. And if I look at, I can think back to talking with my grandmother in 1994. Maybe she was in her 70s or 80s, and she had a municipal bond portfolio yielding like 6 or 7%, the tax-free stuff. And it's like, that's just comedy. That doesn't exist today. When you're thinking about, okay, I need to take more risk, because that guarantee, that kind of quote, risk-free doesn't really exist. I mean, so to speak. I mean, the risk-free return doesn't really exist. So how has your discussion with people changed in an environment where Germany is now releasing bonds that take your money to hold their bonds? I mean, it's a really wacky world that we no longer have interest rates, isn't it? Especially for someone who studies economics in the retirement field.
It's very interesting times. I think this is why we need to really understand the trade-offs more than ever. It's important to understand risk-free. It's understand to price what you would like in the risk-free terms, but often you can't afford it. Risk-free is just really expensive. It's just, if you don't want to take any risk, you're just going to have to save a boatload or retire really late. I mean, it's a price. This is where the market's pricing it for a variety of reasons people can debate. I think people need to be mindful of, all right, well, what am I comfortable with? If I'm not comfortable with risk, I have to accept the fact that I want something that's incredibly expensive right now. Or versus, well, I guess I do have to take more risks. I just can't afford to have a low risk portfolio. But from there, you don't have to. I think where people get lost is they're like, well, I guess I have to take risk or, reach for a lot of yields. And it's not so simple. You have to think, all right, this is what I want in risk-free terms. Maybe I can't afford it, but how much risk do I need to take? Exactly as much risk do I need to take to get to what I want? So you don't just have to shoot for the moon blindly. You can be thoughtful about it, but you do need to raise the trade-offs, especially before you didn't have to as much because the risk-free return was so high. You didn't have to take any risk. You didn't have to put that much thought into your retirement strategy, but now you just do.
Let me keep you here for a second because I'd be amiss if I did not probe your mind. You've done so much work here. So if I look at Germany releasing these 30-year bonds at negative rates, does that tell me as an outsider looking in, does that tell me that the governments are imagining decades and decades ahead into the future as things being really bad?
I mean, I don't think so. These are market prices. It's complicated in Germany too, because still have so many defined benefit pensions there. I can't remember, but I think they're only allowed to invest like 25% of them in risky assets. So you have some regulation there that keeps companies wanting to buy a lot of long duration, safe assets.
Is it doable in the States? I mean, can you imagine it in the States?
Yeah, why not?
So, okay, we go minus 1%. Okay, minus 5%. Is there a minus percent where it stops and we have a revolution?
Probably.
Oh, I got a probably. I like that one.
I mean, at a certain point, people would just hold their money in a bank account. They'd find the least dirty shirt on the floor. They would find something, or maybe, I don't know, technology will catch up and people will find a way of doing high yield savings accounts. I mean, I said these are all market prices. So people just sort of will shift into whatever. This is it. We just might move to a world where low risk is just very high. Although I don't like to make predictions, but I think eventually rates will go back up. People say we're in a lower rate world, but that doesn't mean we're permanently in a negative rate world. I mean, it could just be right now people are really nervous about a recession. So people are just putting a really high premium on safety. But, things change.
Hold on. You're a very, very smart lady with a lot of background. And that trend on those rates has been going down for over a decade, yeah?
Yeah, but when I think of interest rates, I like to think over hundreds of years.
But they haven't figured out life extension yet. I can't count on that.
Well, I don't know when. I said when rates go up, I don't mean they're going to go back to 6 or 7%, but maybe they'll be in a really sort of solid 3% area.
Which gets to your point about, I'm guessing one of the big reasons you write a book like this is that, yeah, if you did have a couple $1,000,000 in the bank and you are in retirement and we are at 6 or 7%, you don't have to think much. You can get by. But we don't have that now. And so you're making the case that if we don't have that, you've got to think about risk in a different way.
Yeah, because I would never tell people what they should do with their own portfolio. I think there's nothing wrong with being a low risk person or risk averse. The fact is most people just can't afford to be. As an economist, I'm just interested in the implications of people who prefer low risk assets to feeling like they are forced to take more risks. They just can't afford low risk. I think there's a lot of macro and behavioral implications there I don't fully understand, and I just personally would like to think more about.
It's an interesting world. I really appreciate you putting this book together, and I think you have definitely hit on something because you're right that when a guy like Peter Bernstein is not around and his book was so great. I remember, was it the late 90s when that came out, early 2000s? it's just fabulous. And I think you rekindle the subject. You get people thinking about it again.
Oh, thank you.
That's great stuff because, I mean, it's a tough subject. It's a tough subject. And bringing in these outside markets makes everyone kind of go, you can relate. You can kind of, oh, I can imagine that.
I mean, that was the hope. As I said, I feel like the ideas he put out there are so important, but so misunderstood broadly. I mean, people in finance love his book. I love his book. I just feel like the ideas really are more critical than ever.
Allison, I appreciate you coming on today. The book that I'm holding in my hands, this nice hardcover copy with some very prominent names in the back, one of which appeared in this podcast before, Tyler Cohen. An Economist Walks into a Brothel and Other Unexpected Places to Understand Risk. I have a sneaky suspicion that other people besides economists have walked into a brothel, but that is an entirely different conversation. Is there a website we can send people to? Any place you would like to direct them?
Well, I have a personal website that has a lot of book information on that. My website, just myname.com, AllisonSchrager.com.
Okay, cool. Thank you for coming on today.
Thanks for having me. It's really fun.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.